let's get into our stock of the day, and we'll continue with that theme, in fact, of what we're seeing, particularly with the economy. Westpac saying the escalating conflict in the Middle East has reduced income in its market decision and will lift credit provisions at its upcoming half-year results. It says net interest margin in its Treasury and Markets division weakened amid heightened interest rate volatility. The bank will also take a $75 million hit from costs tied to the planned sale of its Rams mortgage portfolio to a consortium, which includes Pepper Money. And the charge reflects transaction execution costs as it simplifies its portfolio. Don't know why that's upside down. Does that actually reflect what was going on in the market at the moment? No, not necessarily. Anyway, I don't know whether that's just our screen or perhaps what we're seeing more broadly. All right, so Sanjee, let's start with you then. And that's an opportunity, what you're seeing in the banks right now.
Yeah, I mean, we don't really follow the banks because they're just not good investments. There's just no growth in them. And the banks aren't immune to an economic downturn. So, I mean, what they're doing right now, lifting their credit provisions, taking precautionary measures, gearing themselves up, I look at that as a warning sign and saying, well, the banks are now caught on to start preparing for worse times to come, which means it's a bad time for any other business that has high debt. So, I mean, something we've been saying for a while, Teaminvest keeps repeating it, but if you've got a high debt business, then getting that debt renewed or extended or to bail you out of a difficult situation should it arise, it's going to be very, very tough right now.
So what would you do with Westpac?
Well, with Westpac, we wouldn't have invested in the first place, but I'd be saying sell it out and find somewhere a bit more secure.
Mark?
I mean, look, the Big Four and that 4 pillars policy is a great thing for Australia. It's a great thing, saved us in the GFC, and you know, that stability in the financial system is really good for the economy. However, I mean, are they a buy in terms of a share, you know, and like trying to make money in the share market? No, they're not. So we utilise the Big Four and Macquarie in our fixed coupon notes. We get around the 10% mark per annum. In structured investments, that's how we utilise them. We don't feel the need to invest in them unless, you know, we bought Macquarie last year, and you know, CBA hasn't been cheap enough for us to buy for quite some time. So, but look, realistically, you're barely going to get what 3-4% dividend out of this, and then you know, you take on market risk, etc. So we've just found another way to utilise their strength, which is their stability in building a coupon note around it, which gets you much better return, and then you get to sleep at night and not have to worry about things. So used in the right way, but in terms of share investing, we wouldn't really consider it. Like I said, CBA and Macquarie are the only two we'd ever consider here, and they're not cheap enough at the moment. So it'd be a sell, and then switch to something that's going to, get you a better result with less stress.
That is a double sell then for our stock of the day, Westpac, and well, if you're both selling it, perhaps they are looking for another opportunity.